Hello, everybody. Welcome back to Capital Ideas. I'm Nick Morgan, co-founder of ICAN, Investor Choice Advocates Network, and co-host for today's podcast.
And I'm Dara Albright, and I'm the co-host of Capital Ideas and a proud board member of ICAN. And today, please join us in welcoming Jennifer Schulp to the show. Jennifer is the Director of Financial Regulation Studies, Center for Monetary and Financial Alternatives at the Cato Institute. She's also the co-author of the new book, Financing Opportunity: How Financial Markets Have Fueled American Prosperity for More Than 2 centuries. Well, welcome, Jennifer. So great to have you on.
Thanks for having me. Happy to be here today.
So first, I want to say thank you so much for writing this book. I think it's so important for people really to understand the integral role that the markets play in fueling innovation and economic growth. And in fact, that's exactly why Nick and I even started this podcast. So really great to dive in and learn more and hear more. So maybe we could start with having you talk a little bit about the markets itself, how functioning markets do indeed create wealth and enable capital to be put to better use.
Sure, I'm happy to do that. I mean, the basics is exactly what you just said, that functioning markets provide the ability for us to move capital to more uses. Instead of keeping your money under your mattress, where it can't do anything other than, I would say, deflate away in value as money changes. Capital markets allow people, industries, and others to invest in ideas that they think will better everyone's position. So you can take that money and you can invest it in your friend's idea. You can invest it in the public stock markets. You can invest it in your own business. And without, say, functioning capital markets, there's no good way to make that happen. You can do it on a one-to-one basis, which is a great way to kind of start growth, but without being able to pool resources and allow people to act together to create bigger ability to move capital, we would always stay at a very small level in terms of growth and innovation. The capital markets allow larger groups of people to come together, and particularly people that don't know each other to come together to be able to invest in ideas that allow us to, I would say, prosper, grow, and make our lives better.
Indeed. So maybe you could talk a little bit about the significance of risk and having the choice, especially in the financial markets, because I know that's really a big thing that we all talk about risk as if it's a bad thing. But maybe you could weigh in a little bit on that.
Oh, sure. Risk sounds scary. It sounds like a bad outcome. If you're facing risks, something bad might happen. But you can't think about risk without thinking about reward. And risk is often the price that we pay for bigger rewards. If there was no ability to take a risk, there would be no ability to reap a bigger reward. And that's fundamental to investing. I mean, quite frankly, it's fundamental to life. We take risks in everything that we do. Some of those are bigger risks, some of them are smaller risks. But our investment return is the payoff for the bigger risk in the investing world. And risk is often thought of as a dirty word by regulators. We want to protect people from taking risks. We want to protect people, particularly individuals, from potential loss. But when you protect people from potential loss, you also protect them from potential upside. And that doesn't get talked about often enough. So none of that is to say that every risk is right for every investor. We all have different risk tolerances. In fact, that type of diversity is what lends to the strength of our capital markets, where you have different opportunities to take different types of risks. But what it does mean is that you can't have capital markets and you can't have growth without having risk.
Yeah, that's such a great point. There'd be no America without risk. I mean, if you think about it, everyone came here, took the great risk, coming from all other parts of the world to get here and build this country in the first place. So yes.
I really enjoyed the book, Jennifer. So yeah, I echo Dara's comment about thank you for writing it. There were so many things to like about it. One of the chapters dealt with sort of piercing the myth that more regulation means more financial stability and less risk. And I thought you and your co-author did a great job of sort of tearing that concept apart. Apropos of that, this morning I read the Bloomberg editorials saying, we were doing this on the eve of a change in administration, and the Bloomberg editorial page made the comment that this supposedly epic deregulation that's coming needs to be tempered because that may also result in financial instability. And that struck me, just having finished the chapter on that topic, that this notion that more regulation means more stability or less risk is not necessarily true. Can you talk a little bit about that?
Yeah, and in fact, it's just dead wrong. American history has kind of proven that. The American financial system has been crisis prone, and we have become no less crisis prone as we have added on regulation after regulation to supposedly deal with the previous crisis. That myth often comes from the idea that after a crisis, someone stands up and shouts, "You know what caused that crisis? Deregulation. Deregulation is the reason that we had financial instability." That just doesn't hold true, particularly in financial markets. If we've looked at the course of regulation over the past century, over the past 50 years, over the past 20 years, it doesn't matter, Republican or Democrat in office, we've seen an increase in the general amount of financial regulation. We haven't had any fewer financial crises. I'll say in the book, we go into quite a bit of depth about why 2008 was not caused by deregulation. I'd say I'd love for you to pick up the book and read more about that. But the fact of the matter is that these choices that are made in regulation don't add to stability. And in fact, they take away from resilience because we have less diverse markets that are less able to withstand shocks because everyone is doing something similar to follow the regulation. Less regulated markets are more resilient and may lead us to a situation where we're not asking this constant question about how do we get to stability. We get to stability by having diverse markets where people can make their own choices.
Such a great point. I mean, you didn't really, it's all about diversification, and everyone is doing the same thing because they're following the regulation. So by nature, that basically causes more risk, instability in the markets. And, I just want to say point, then I know I'll give the floor to Nick, but it's, the SEC, you mentioned 50 years, 20 years. The SEC came about in 1933, basically supposedly as the answer to the cure for the Great Depression. It came during the Great Depression as the cure for the stock market crash in 29, which we were told it was caused by fraud in the markets. But if you look at what was actually happening at that time, people were buying the majority of their goods, their household goods, on installment plans, and then they were buying stocks in the market on 5% margin. So really, it had nothing whatsoever it was a bubble. It had nothing whatsoever to do with fraud. They just used that as an excuse to create the SEC.
And they used the idea of speculation, that there was too much speculation in the markets as a reason to heavily regulate these markets. We're less heavily regulated than markets in other places in the world, but the idea that we have kind of free financial markets in this country is plainly not true. But speculation goes exactly to my point about risk. Risk is required in the markets, and speculation plays a vital role. It wasn't true that there was too much speculation in the markets in 1929. Again, we talk about that in the book. When academics have looked back at it, no one can really point to what is too much speculation and how do you actually measure that. But it's a given fact that speculation is an important part of a functioning financial market. And trying to define what is too much is a fool's errand.
I thought the book did a great job of going back into some of that history and not just back to the Great Depression in 1933, but back to the founding of the country and even back to Aristotle. I mean, there's a lot of the ideas that we're talking about are not new. They're certainly not 200 years old. They're even older than that. So I would get the book just to read like the quotes from John Maynard Keynes. Alexander Hamilton comes across pretty well. So that was also nice to see. One of the things I thought you did particularly well was talking about the value of secondary markets, which seem to come under fire from people at all points of the political spectrum. I happen to be sitting at a conference of people who are involved in private investments in public equity. And so can you talk a little bit about the value of secondary markets? I know you had a whole portion of it, so don't expect any recitation of that, but even just the point on price discovery, I think was really useful.
Yeah, secondary markets are vital, and without secondary markets, you don't really have a functioning primary market. If your investment is only to be locked in henceforth and forevermore, it makes it much more difficult to take that risk off the bat. Secondary markets are often criticized as not creating value. The value only occurs in the primary markets because that's when you're giving money to the company to go do something with it. There's value created there, but there is a lot of value created in the ability of people to change their minds about an investment. To be able to move in and out of that investment, to have a functioning, as you said, price discovery process where we have a better idea as to what the market thinks about what that investment is worth. It's funny, private equity, one of the main criticisms that we hear about private equity is about pricing. How do you understand what a private company is worth? Well, secondary markets go a long way to solving that problem. And to criticize secondary markets for not providing value, I would say misses the forest and the trees in that process.
Well, maybe we'll leave it there at the risk of giving away all the spoilers in the book, but I really thank you for coming on, Jennifer. Thank you, Dara, as always, for co-hosting. For the rest of you, you should go buy this book, Financing Opportunity, put out by Cato. And of course, we're very happy that Jennifer's on ICAN's advisory board. And everyone, please tune in to the next Capital Ideas from ICAN. Thank you.